Welcome to all our Rain King Insight members, and welcome to our guests for our free monthly general market update. We started this week looking for a rally and a follow-through day, but it ended with a 2-day waterfall decline. We're going to cover it all, break it all down, and see where do we go from here. All right, remember that the presentation is by Rain King LLC for educational purposes. All right, here's our overview. We're going to look at a couple of other bear markets, really fast and deep bear markets, 1998 and 2018. Then we're going to continue our discussion from last week about the scenarios, and was 10% going to be the limit to the correction, or 10% was maybe just to get started. Then we'll look at the Fed watch, what's coming next, inflation or recession. And then we're going to look at our watch list. It's important to stay engaged. We're going to look at things on the long side, what should we be looking for, as well as on the short side. And then we'll put it all together at the end. All right, let's look at a couple of precedent markets, corrections that turned into bear markets. All right, here's the 1998 bear market. It was deep and fast. The 1995 to 2000 period was a very, very strong bull market. It did have some sharp corrections along the way. So this is happening. This correction is 3 years into a bull market, which is really similar to today. Now, it was a bull market that the correction started as a leg down of about 14%. And what really, really scared the market back then was long-term capital management, which was a bunch of Nobel laureates who had all these computer algorithms and were just really performing incredibly well and outperforming the market. Well, they were levered up. I think it was 100 to 1, and things started to implode. They weren't expecting on world events to affect their modeling. Unfortunately, the Russian bond default crisis and long-term capital management went into a spiral. The bond crisis in Russia created the second leg down in 98. It was a 21% leg down. There was a brief rally. There was a follow-through day in here that had a brief rally and failed. And then by September of 1998, long-term capital management had lost over 83% of its value and had to be bailed out literally by the government. So it was a really, really challenging time in the markets. The last leg of this bear market was 27% decline. The total decline was 33% in only 3 months. Eventually, there was a follow-through day here, which kicked off a strong rally, and we ripped higher into the 2000 top. Now, the question is, when looking at this market, you can see the first leg looked fairly benign, and the market actually drifted sideways for a number of weeks before things really started to decline. And we had this very strong waterfall type decline. The question is, are we in the current market experiencing this, the second leg down, and possibly a deeper bear market? So let's look at another one of these. Let's look at the 2018 market. And this was really driven by the Fed that was raising interest rates. But again, it was a 3-month, very fast bear market, and it was deep. It lasted a total decline of 24% off the highs. Now, the first leg again of this bear market was again fairly benign correction of about 14%. And again, the market here had a follow-through day that looked like all was clear, but it wasn't. There was another 10% decline. Then there was another failed follow-through day, the number 2. And then we had the very sharp waterfall decline into the Christmas Eve massacre, which was leg 3, which was a 17% plus decline. Eventually, the Fed got the drift of it, and Powell reversed course and talked to the markets in a way, and a follow-through day got a new rally started to kick off 2019. But it was sharp, it was declining, and was very bad looking into the exhaustive selling that occurred on Christmas Eve. So again, maybe if you try to draw some parallels, this last waterfall decline, maybe that's equivalent to where we are yet. You'll notice that, we have not had a follow-through day rally yet. So let's look at our market. Here's the NASDAQ composite. The first leg down was about 14+%. Again, we had this kind of drift sideways. It was a slight upward bias, but we never got a follow-through day, not a clean sign of accumulation. And this week we came in, we had a little bit of an undercut, looked okay. We had a couple of days up. Then the news came out on Wednesday, and the market was really shocked by how expansive the tariff policy was going to be. And we've had an 11% decline in only 2 days. That's really historic. That type of decline, I don't think has happened since 2020. And before that, it was the great financial crisis back in 2008. And before that, I believe it was 1987. So we are now at the intraday lows today. We were 22.8% off of the highs. So we don't know how deep this leg is going to go and when we might get a rally attempt. But it's really driven by the tariff being much more expansive. Now, this is actually, there was a news headline at 4:29 p.m. yesterday, and that was where Peter Navarro was on CNBC, and he said tariffs are not a negotiation. They were firm and they're not going to change. So that news comes out. Then literally less than a half an hour later, Trump says he's still open to tariff negotiations. It's this kind of action that it really has the markets uncertain. They don't know what to expect. People within the cabinet don't even have the same message. This kind of public negotiation of tariff with nations is not helpful, and the market is reflecting the uncertainty and are taking risk off the table, creating some of this decline. So this type of stuff has really, really been tricky for the market to handle. Now, when we look at the bull market, the bull sectors have been topping out, and we've been talking about this with members for a while now. I've been expressing over the last 6 months my concern about the semiconductors. The rally that started in November of 2023, the semiconductors were the #1 leading sector. They topped out in June of 2024, and I said, this is really important that we don't lose the semis in terms of the bull market. Well, we did lose the semis since the beginning of 2025. Things have gotten really bad with the semiconductors. Also, the home builders. The home builders topped out in October of 24, and they've been going down steadily since. And we're going to talk about the home builders a little bit more in a minute. Software tried to pick up the mantle from the semiconductors. It lasted to about mid-December, and then the software group topped out. The NASDAQ itself really peaked in December as well. Had a little attempt at trying to get to new highs in February, but it failed, and now we are in a decline. Now, the last two bull sectors that really you don't want to see fail are the financials, XLF, and the broker-dealers, XBD. Well, both of them have really rolled over hard this week in the last 2 days. So this is fairly definitive. The bull market is over, and we're starting to, we'll have to rebuild, get through this bear market, and be ready for the next opportunity. Now, retail has really taken it on the chin. I've taken the retail index, which is XRT here, and you can see that this is where Trump inauguration day was in late January. And you can see that the XRT, the talk of tariffs was certainly scaring retail in general because a lot of retail companies have their products assembled overseas. But you can also see that sneaker companies, footwear companies, clothing companies, Under Armour, Nike have really, really been hit hard. And then the news this week that the expansive tariffs were going to be even worse, and retail has been decimated in the last couple of days. So retail is really, really in trouble here. Not sure how this is going to play out and how they can actually reposition where they manufacture their goods. Now, I wanted to come back to the home builders because I think there's something interesting going on a positive way with this particular sector. Now, the sector, as I mentioned, really topped out in October, and it's been in a steady decline. It's been below its 50-day moving average in red for many, many months. Now, what's interesting is the market hit a low back here in middle of March, and the semiconductors hit a low. And you can see here, this is RSI on the bottom, this indicator. What's interesting is today we had a new low in the market and we had an upside reversal in the home builders. And you'll also notice that the relative strength line is actually at a new high way, way before price. So that's kind of interesting. It's really a divergence. And you'll also know that the RSI indicator at the bottom panel has also not made a new low, even though the price of the home builder sector made a new low, but then it had an upside reversal. So this is interesting. If we're going to go into recession or we're going to have just an economic slowdown, that probably means interest rates are going to come down. And if interest rates come down in a meaningful way, that could spur mortgages to be refinanced as well as new home building. So I definitely going to take a deeper dive this weekend to look at some stocks that looked really interesting action today. DHI and VR, PHM looked really interesting. And even some of the related Zillow as well as Rocket Mortgage had very strong relative strength. So this could be an opportunity that we really, really want to be tuned into if the market can get a rally. So continuing our discussion of the last few weeks, we didn't know if a 10% correction was going to be the limit or that was just going to be the beginning entree to something much deeper. Well, today we know the answer. Now, this slide was taken from our general market update on March 13th. This is weeks ago when we really said, let's be open, let's be flexible, and be prepared for this market. And we said there were three scenarios to be prepared for. The first was the blue line said maybe we just get a nice V recovery, we get a follow-through day, and we get back to new highs. The second one was the green line that said maybe we get a follow-through day, but it actually doesn't really work and comes back down, undercuts the lows. We undercut a bit, and then maybe we have to rebuild. So that didn't happen. Neither one of those happened. The third opportunity that we wanted to be prepared for, we said, what if we get a very weak rally, no follow-through day at all, and then the market breaks? And that was the scenario that we've gotten. We got a weak rally for the market going sideways for a couple of weeks. We never got a follow-through day, and the market now has broken much harder even than this simple diagram that we drew on March 13th. So we didn't want to predict anything. We wanted to stay open and flexible. Now, looking at this, we've got the S&P 500 line chart in the top panel. Then I've got the put-call ratio in the middle panel, and we've looked at these over the last several months. And in the lower panel, I have new highs and new lows. So the S&P has broken to new lows, and we've gone up very, very sharply. And finally, we've seen some fear really come into the market. Today, the index spiked to 1.3, which is at the level where people are buying puts, and they're very, very fearful about the market. And we've talked about you definitely get above this green line here, with showing high fear, which is really associated with market bottoms. You can see the intermediate correction from 2023 actually was well into the fear level before we finally came out of it. And you can also see some of the other events along the way. And I had mentioned the past couple of weeks that this was not really showing us that the bottom was in. So we've got some spikes here. We've got some put buying. That's a good sign that might be a building block for a bottom. The second thing we noticed this week is we really slammed to new lows. We had the largest number of new lows on the New York Stock Exchange since way back over here, which was the October 2022 bottom of the 2022 bear market. So we're seeing some extreme readings. So we just want to be open, but we're finally seeing the type of action, and maybe some exhaustive selling will be coming in to give us a reversal for potentially a rally attempt. Now, I also gathered this chart. This is the S&P 500. The VIX spiked today over 45. And this looks at when you get those spikes, and here's the historical table. You can pause your video player. You can see, what did the S&P do 1 day later, 2 days later, 3, 4, 5 week, or 2 weeks later? In general, you can see that the chart is pretty green. Even during the COVID plunge, you can see that once the VIX really spiked and came back down, you can see that some of the readings in the next few days for the S&P, there was a bounce. So you can take a look at this and take it as you will, but we did have some spike in the VIX today. All right, let's turn to the Fed watch. And the question really is inflation or recession? So I want to start with this sector chart. And we've used this before in the membership. We always want to know what's happening with the different sectors of the market because the economic cycle is very, very consistent, that during peaks of the economic cycle, slowdowns, recessions, and recovery and expansion periods, certain sectors do better. So this chart here is showing since 1960, these are the returns of the sectors during the phases of the market cycle. So we're going to look at the recession period and the slowdown period in a little greater detail in a moment. But if you're interested, pause the video player. When we're in expansion mode, you can see the sectors that really perform, recovering from a downturn or a bear market. These are the sectors that perform the best. And we're going to look now at what happens when you have either a slowdown or a recession. So I've blown these up so we can see them a little better to kind of look at the two scenarios because we don't know which one this is going to play out as. Let's start with the lower panel. This is for an economic slowdown. So the bullish sectors are generally these sectors right here in bull markets. Now, in a slowdown scenario, you can see technology, industrials, financials, consumer discretionary, they don't perform as well as some of the other sectors, but they still perform, but they underperform if the economy is slowing down. So we want to be aware of that. Now, if we are going to go into a full-blown recession, you can see that these bullish sectors, technology, industrials, financial, consumer discretionaries, get absolutely crushed. And you can see that they're all negative. Over the last 50 years or so, technology on average goes down 20% during a recession. So we don't know which scenario it's going to happen. But the reason we look at sectors so much is because, William O'Neill's data shows that 37% of a stock's price moves is tied to its industry group, and 12% of its move is tied to the overall sector. So we want to be aware what scenario are we going to end up in, and we know that the sector is the important piece of the puzzle in terms of which sectors are going to perform as we come out of a downturn or a bear market, and then eventually we'll go to groups that we know that are performing because that combination is over 50% of a stock's move. Now on the Fed watch, if you go to the CME Fed watch, this table is starting to show that there's a 50% chance that there's going to be 3 rate cuts by September of 2025. I believe it was JP Morgan put out that there's a 60% chance now of a recession this year. And that probably puts us in a place where you say, well, are we going to get Fed rate cuts if we go into a recession? Now, this is a really tough one because the Fed is in a very tough spot here. If the tariff policy sticks, it's likely to show inflation rising again. And it's going to be very difficult for the Fed to say, let's cut rates if inflation is rising. Usually, as you know, the Fed has to raise rates to cut off inflation. So the tariff policy is challenging. Now, if the Fed sees the labor market and the economy slowing down and headed towards a recession, it can justify some cuts. But it's a really tough situation. I imagine that they're probably going to want to see the data before making the decisions. But this is a really tough spot that the Fed is in now that the tariff policy is out there. So we'll have to see how it plays out. All right, let's turn our attention to the watch list in terms of long lists as well as short lists. Now, we always want to stay engaged, even though the market is very ugly right now. It's easy to want to just turn away, but we need to stay engaged for different scenarios. And let's take a look at a couple things that I'm looking at. All right. Now, on the left is the likelihood is we're going to see a lot of double bottom bases during this decline. And then we've had this panic driven, we undercut the lows, and most stocks have undercut their lows from March. So they're forming potentially the second leg that might become a double bottom, where you have a leg down, a rally, and then a second leg down in a recovery. So that's a possibility to see a lot of double bottoms. Now, on the watch list right now, here are some names that are doing that. Have had the initial undercut, but are still showing relative strength that warrants being on a watch list if the market turns and rallies. Palantir, LTH, you can see this list, and I encourage you to look at these names over the weekend. Now, the second potential situation is we have high relative strength names that don't undercut. They're actually showing extreme relative strength, and they're not coming down with the market. So those we definitely want to have a watch list to be aware of. Some of the names that have made my watch list that are in this scenario currently are Spotify, CrowdStrike, TGTX, Halo. Even Tesla has not undercut its prior low, and you can see the balance of the list. I encourage you to go look at some charts this weekend and try to develop your watch list and be sharp about it, about which ones really are showing some good action, because there are some stocks still hanging in there. Now, the relative strength concept, I wanted to go over this to show you what you should be looking for. Now, this is the NASDAQ in 2018. We always want to correlate what's going on with the index and what's going on with the stocks. So in this case, what we're trying to show is the market makes a new low at point A in this particular bear market. And I've got Twilio from 2018 lined up. And you can see at point A, what does Twilio do? It makes a new low. Now, the market had a failed follow-through day, and it made a new low at point B. So we have new lows in the market. But you look down and you say, what did Twilio do? It actually did not make a new low. You can see this is a higher low from point A to point B. That is showing some really strong relative strength. The market is weak, but this stock wants to move higher. In addition to that, you can see the relative strength rating and line. The relative strength line was actually in new high ground, new highs in the relative strength line. Even though the market was declining, this stock was showing characteristics of really what we call a positive divergence. The relative strength line was making new highs before price, and the stock, you can see the stock actually is making new highs right here, while the index is still way off its highs. So try to look for this action by looking at those names on the watch list on the long side. Now, turning to the short side, we short technical weakness. It's much too late to short now. And that's why in the membership, we were looking at shorting a couple of weeks ago. It's too late to short now because it's obvious. Everybody sees it now, so it's too late. And we're more likely to get a rally attempt, and maybe we get a rally that maybe materializes into a follow-through day. So there's a number of names. Here's a few that are on the short watch list, but as I mentioned, many of them are not in position right now as short setups. We've had a couple the last couple of weeks, and Rain King Cloudburst members in our focus list, we've had some really successful shorts. We had Shark Ninja, we gained 25% in 8 days. We had Clavio, we were positioned well in that one. We got a 24% gain in 9 days. And we're currently in AppLovin, which is actually working. It's about a 27% gain in only 3 days. So that one's still an open position for members. So we want to keep aware of stocks, because if we do get some sort of weak drifting rally, that's when we might find another opportunity to short, but we don't want to jump the gun. A name that I brought up just last week from the short list, and I put it in the general market update on March 28th, was Reddit. And I said Reddit had set up into an L-shaped wedge opportunity here as a short. I said there's a couple things that could happen. We could actually rally up and then fail, or I said we just break this ledge and it becomes a really good short entry as we broke the lows. So here we are 1 week later. This worked out really, really well. You can see here that we broke and gapped down through the ledge, And this short gained approximately 25% in only 3 days. Very, very quick gains on the downside. So Reddit was one that was also identified in the membership. All right, let's try to put this all together where we are. So the fat lady sings, the bull market is over. And really this bull market, ended, and we're now really approaching bear market territory. We're over 22.8% off on the NASDAQ, 17.5 on the S&P. And really it's been self-induced by the new administration. The new policies are really, really not being received well. A lot of mixed feelings about will they be effective over the near term or even over the longer term. We're not above the 20. We're far away from being above the 20 exponential. We've had the highest number of new lows since the 2022 bear market bottom. Maybe we're going to get some really exhaustive selling here, and we're starting to see it. The tariff policy is, obviously started to accelerate bear market leg number 2 lower. Exposure levels, most likely you should be in cash. I have 10% here because we are playing a little bit. We had some short positions out there. If we do get a follow-through day in a rally, we're probably going to want to put 10 to 20% of our portfolio to work if a follow-through day occurs. But in general, most people should be in 100% cash. So there's finally some real fear and panic in the markets. And what that really is potentially leading us to is maybe we get some big capitulation selling that actually clears the way for a reversal and a bottom in the market. And we might get a follow-through day with a rally attempt. So we probably are one step closer to that rally attempt happening, as ugly as the last 2 days have been. We're looking for a reversal. We're looking for a potential divergence between new price lows and the action on the new high, new low list. So we also want to be open that it is potentially possible that we get another one of these really, really weak drifting up rallies, and there is no follow-through day. And that might be a great place as stocks drift higher with weak volume and setting up another shorting opportunity that we could take advantage of. So again, be very, very open and flexible here. It was a tough end of the week, and hopefully everybody got through this fairly safely. But who knows? We don't know how deep it's going to go yet. We also don't know, how long it's going to take to get through this bear market. Will it be one of these 1, 2, 3 month bear markets, or would it be something much more grinding like the 2022 bear market? So the quote of the week is from Groucho Marx. Who are you going to believe, me or your own eyes? So it's not about the news necessarily. It's really about the market's reaction to the news. I'm not really listening to any talking heads saying how great the future is going to be, or doomsdayers who are saying, oh my God, this is the worst thing in the world. I wouldn't be listening to that. I'd be listening to the market. We know that we're in the beginning of a bear market. We don't know how long it's going to be. We don't know how deep it's going to be. We want to protect our capital because we always know that coming out of these periods will be super duper opportunities to make a lot of money if we're engaged with the market and we have a very sharp watch list. So stay engaged and let's take it day by day. That's the general market update for April 4th, 2025. Have a great weekend, everybody. I know I'll be looking at a lot of charts this weekend, looking for watch list names and opportunities for the focus list for next week.